Hey, welcome back, everybody, to the Today's Market Explained series. This is a podcast media event and video series by Four Star Wealth. I'm Brian Kasal. I'm the founder and CEO of Four Star, and I'm host of the show today. We're going to talk today about multifamily real estate investing. Of all the real estate categories, it's one of the best categories that people can invest in. It's really consistent returns. We've got some experts on here to join us today. So we've got the president of Burlington Capital, Dominic Vaccaro, and then we've got Jack Cassidy, and Jack is the managing director of real estate, also with Burlington Capital, and Burlington is in Omaha, I believe. So, so welcome, gentlemen, to the Four Star Today's Market Explained.
Thank you. Appreciate it. Thank you, Brian. Appreciate being here.
Absolutely. Excellent. So we're going to talk a little bit about investing. And the reason we do this, as investment advisors, we obviously run stock and bond portfolios and do all the traditional Wall Street stuff. But many investors look to other alternative investing to add augmentation to their portfolio returns, lower risk through managing variance. And so that's where real estate comes in. So gentlemen, let's talk a little bit about multifamily real estate. Can you tell us about your experience and history in running multifamily apartment buildings?
Absolutely. Once again, appreciate, Brian, the opportunity to be with you all today. I'll share with you a little bit about our company's origins and entree into multifamily real estate. As you mentioned earlier, our firm is based in Omaha, Nebraska, founded in 1984. And in total, we've sponsored 27 different combination of public and private investment programs serving our investors, 17 of which of this 27 total prior funds have been focused on multifamily real estate. And those started with our company's founding. First funds were based on multifamily. So we clearly have a long-term track record dating back nearly 40 years at this point, focused on multifamily, and we've stuck to that discipline within real estate, focused on multifamily.
Excellent.
The duration.
Lots of experience. So, there's a lot of multifamily players out there, Dominic. So, what would differentiate a good operator like you versus not a good operator?
So we have some operating elements that we think differentiate ourselves, but we thought it might be interesting to talk about a few instances really where we take an investor first mindset into our approach. And Jack has some interesting stories to share and that really characterizes that pretty well.
Yeah, Brian, as Dominic pointed out, we've been involved with multifamily for almost 40 years now, initially as a lender. And then we slowly migrated towards ownership, not necessarily by choice, but we had got involved as a lender in a lot of real estate, multifamily real estate in the mid-'80s. What happened shortly thereafter is because of the huge influx of supply in multifamily throughout the country in almost every market, we found as a lender that we were getting in trouble. Some of our operator owners were in trouble and not meeting the debt service. So we took the strong approach and basically foreclosed on most of them.
Mm-hmm.
And at that point, in the 1987, 88 timeframe, we became owners of real estate. So we learned the hard way. We learned about cycles very quickly in multifamily and how to deal with them. The good news on our end and for our investors was that by foreclosing, we wiped out the debt. So we owned these properties 100% with no debt, which allowed us to survive the downside and the real pain that was going on in multifamily real estate at that point. So that was one of the good items from our standpoint that differentiated us from a lot of the owners back then who were getting foreclosed on. So that was positive, and it allowed our investors not to lose any money. We kept those properties that we foreclosed on for another, in some cases, 5 to 10 years. And in all cases, we were able to sell those properties at a profit. So every one of those investors made money.
Nice.
One thing that happened at that point when we took over properties, we brought in third-party management teams, because at that point, as a lender, we did not have a property management team in place. So we brought in third-party managers. And after a couple of years where we were acting as owner and asset manager, we realized that we were not getting the kind of quality property management that we expected from our third-party managers. And the founder of Burlington called us all in for a meeting, and he looked at me and he said, "Jack, we're going to start our own property management company." Yeah, his name is Mike, and I said, "Mike, I think that's a great idea, but I'm not really equipped at this point to become a property management company executive. It's not really been my background." And he looked at me again. He said, "Jack, we're going to start a property management company. If you don't want to do it, I'll find somebody who will." So myself and another gentleman started the property management company in 1992. And it's been a very important part of our growth story and our ability to return to our investors very good returns over the years. The thing that you find when third-party managers, we were getting a lot of personnel turnover. And once you get involved with property management, like almost any company in any business, turnover is not good. It doesn't help operations. It only hinders. And by taking on property management ourselves, we were able to find stable on-site managers who in turn hired strong maintenance people and leasing people. And we just saw a tremendous improvement in our operations at that point. So it ended up being very positive. The other thing I'd like to talk about that Dom mentioned is what differentiates Burlington Capital from some of our other people in the multifamily space.
Yeah.
And that's our priority of investor first on everything. Back in 1988, we raised money to buy distressed savings and loans. A little different from today's banking crisis. The savings and loans got in trouble in the late 80s, 1987, 88, and the government started to take over a lot of the S&Ls. We raised money to buy one, and in 1988, we were successful in buying a Western, it was called Eureka Savings and Loan in San Mateo, California, at a very good terms with the government. And we basically operated that bank for 10 years and sold it at a significant profit. Shortly after the purchase of that first bank, we raised another $200 million to buy a second bank. Unfortunately, the government changed the rules at that point, and it was not quite as profitable an acquisition at that time after they made the rule changes. We couldn't find a bank at that point at a price and at terms that we felt were acceptable and could provide our investors with a solid return. So this is where we distinguish ourselves. We basically sent back all the $200 million to our investors and never invested in another bank. It didn't make sense, and that was the decision we made. And believe me, the brokers involved were not happy. We found a compromise. They still got their commissions, and the investors were happy.
Sure.
Well, because we did the right thing for them. Moving to multifamily, in 2005 and 2006, we saw a tremendous increase in the interest for multifamily. We had a pretty good portfolio then of about 35 properties in a real estate investment trust. It was doing extremely well. It was distributing a very favorable cash on a quarterly basis. But what was happening as more and more equity and ownership interests were flowing into multifamily, cap rates continued to get lower. And at one point, they were almost on par with the 10-year treasury.
Mm.
And it became very difficult for us to find properties in locations we felt comfortable with that had growth stories that we felt was also at a price accretive to the REIT at that point. We continued to bid on properties, but we were not bidding at a price that the market was paying, so we weren't getting any properties at that point. We continued to show discipline and not buying anything that we felt was not in the best interests of our investors. And eventually, we went to the board and said, guys, we can't continue to find anything that's going to grow this REIT. And I feel at this point, the market has become very frothy. People are paying very low cap rates for properties that I think in the long run is going to come back to haunt them. Maybe we should be selling our properties. So the board eventually agreed with us. We hired an investment bank, signed a deal, and we got 23 bids for the entire portfolio initially. Culled that back down to 3, worked with the final 3, signed a deal in June of 2007 with hard money, non-refundable.
Right.
Went to our investors for a proxy, publicly traded fund, got the approval. We closed in September of 2007. Every investor got all their shares. They got cash for every single share outstanding. And the return to our investors was very, very favorable.
Nice.
So it was another example where we said, yeah, we can keep this REIT and still collect our fees, but this is not making sense. We cannot understand the market at that point. It was acting irrationally in some respects. And we decided the best thing to do was take advantage of that and sell everything and take the cash and give it to our investors. So those are, I thought, we think two good examples of what differentiates us from some of the other players in the multifamily space.
So you'll manage the cycles essentially. And when things are really expensive, you might sell some property and not just hold it for the cash flow.
Correct. Yeah. We've now, because of our close to 40-year experience, we have a few scars from several cycles, and we've learned from each one of those. As you know, experience is dealing with some of the mistakes you've made in the past, and you hope you don't repeat them. So we've had the advantage of going through several cycles.
Excellent. And then you have a fully integrated process too. So you do everything under one roof. Let's talk about that too.
So we think that really starts day one. And when you say everything, you've heard a little bit about our experience. When we became equity owners of properties, we felt it was terribly important to integrate property management to ultimately drive the results for our investors. In addition to property management, there were a number of properties that we had foreclosed on in our early years that still required some construction. So overseeing construction work from the earliest days of our company and getting comfortable with that has been very important, as today we seek to acquire value-add properties that not only require intensive hands-on property management, but also a very important element to that is overseeing construction. So for us, when we talk about the importance of vertical integration, it starts day one, where oftentimes our first call after we see an initial property that might be available for sale, our first call is typically to somebody in our property management team who's on the ground in a particular market. It very quickly helps us determine, are we in the right school district? Are we in the right location? Are we on the right side of the street? That helps us determine, is this property going to be something first and foremost an investor is not going to lose value? Is a property going to hold value over time? Secondarily, well, we look to certainly job growth, things of that nature, to see opportunities to grow the value. That's where the integration with our construction teams is important as we plan for what are the renovations we're going to try to achieve, what types of incremental returns are we going to see on those renovations, and then ultimately, as we move from the initial planning and due diligence phase to the acquisition and implementation of those efforts, where we work in close coordination with our property management, asset management, construction management teams to carry out our plans. All of that being said, we also like to remain flexible. So as market conditions dictate, sometimes we alter the scopes of our renovations. Sometimes we do more, sometimes we do less. We really like to maintain a flexible approach to our capital improvements as market conditions dictate.
Sure. So that's interesting. So let's talk about the category, multifamily itself. There's a lot of different categories of real estate. So what makes multifamily one of the more attractive categories in investing in real estate?
You led off the show, Brian, talking about the long-term results that multifamily has delivered, particularly as compared to the other commercial asset classes, where consistently over the last 30 years, one statistic that we think is very interesting is over the last 30 years, multifamily has delivered the highest average returns with the lowest risk in any 7-year increment over that time period. So certainly the long-term fundamentals for multifamily have been attractive through the years. Where do we sit today? We still have, particularly with affordability issues, a long-term opportunity where there's a shortage of 4 million apartment units, and the affordability not only for home ownership but also in Class A multifamily is so much higher. Ultimately, we're trying to acquire Class B and C properties in good locations where we can make some improvements to those properties but still not compete at the price point of new construction. And so that's where we believe the opportunity still exists today. Jack, maybe touch on we are certainly aware of the headlines we all read about the amount of supply coming into multifamily and how we believe our approach allows for some insulation in that wave of supply.
Yes. Following up on some of the things that Dominic said, when we do go look for properties to acquire, it's important that we find stable neighborhoods as well. So we don't like to buy in submarkets that are basically overrun by multifamily. We have found over the years that if we can find locations that have both single-family home ownership, residential neighborhoods, in addition to other multifamily competitors, it tends to be a more stable submarket and doesn't have the same issues that we have seen when we buy in a market or in a submarket that's dominated by multifamily. So we like the stability of that home ownership or that condo ownership in the markets, in the submarkets that we go into. As for the actual markets we go into and the types of and the size of the properties we buy in the B and C category, because of our size and because of our history and operations, we now have become fairly efficient in operating properties between 100 and 150 units, which keeps out some of the big players and some of the institutional money that oftentimes bids up pricing in the multifamily space. Ideally, we like to get 2 or 3 properties in a market and allow for a little more on the operational side for efficiencies. Sometimes that's harder to achieve than we'd like, but that's ultimately our goal in some of these markets. We also tend to find markets that ahead of some of the institutional money. We were at Nashville in the mid 80s and into the early 90s when Nashville was not considered an institutional player for residential.
Right.
And we did extremely well back then. Today, Nashville is very expensive. It's overrun with institutional money, and we are unable to find anything that makes sense at the price that we're willing to pay in Nashville today.
But you're very price sensitive.
Yes, extremely price sensitive, and we just have learned over the years, discipline in the long run and patience pays off.
Yeah, but I would say that's also one of our keys has been working hard to find the next market. So we were early on, well, when we started to identify some of the trends in Nashville, we pivoted to Chattanooga, for example, or when Charleston would be another example of a market we were early adopters of, but we later pivoted to Savannah. And so we have a number of examples. We recently bought a property in Athens, Georgia, where we were trying to find a next up and coming market that we think will be generate long-term growth.
Excellent.
Yeah.
So we've seen a big run for multifamily, and there's still some supply issues that we still need to continue to build more units available for the public. But because of the interest rate environment now and the economy slowing down, we might see it slow down a little bit too, I suspect, right?
Certainly we're seeing, expecting higher deliveries of new product from projects that were started 2 and 3 years ago. But the combination of interest rates today where they're at, as well as construction costs, it has made it certainly challenging to start newer multifamily projects over the last 12 months and even today where we sit. So we expect that to have a longer term effect in terms of the ability to generate new supply over time. Certainly between this year and next year, deliveries are anticipated to be high, but it's going to have an effect.
The other factor, Brian, as you know, that's now recently come into the marketplace, and that is with the current banking crisis and what the Fed has been doing over the last year in raising rates. In conjunction with this crisis, there is a growing concern that the banks are going to become extremely conservative on the lending side of things. And as you know, construction lending is a little more risky, obviously, than buying an existing property. So I don't know, I think we're going to see the slowdown in supply and new construction in part because of the a more conservative approach that a lot of the banks are going to have to take for at least the next couple of years as we hopefully navigate through this current crisis.
So we're in the middle of a little bit of a banking crisis here right now, as you guys know, where Silicon Valley Bank went down and First Republic Bank had to be taken over, and now there's a bunch of other smaller banks that are in trouble. So we're dealing with that banking crisis, and interest rates are higher, and so there's going to be some mistakes made in the real estate market too. So what do you guys see as the mistakes that other operators are going to make? And then let's talk about what you guys are doing differently to avoid those mistakes.
But generally, we started talking about one thing that's been consistent for us through the years. Really started with our founding. We talked about within multifamily, we started out as lenders, and where we actually provided the debt to finance properties, but our position was unleveraged. And so when we ultimately had to foreclose on properties, we ended up owning them free and clear. But that taught us an important lesson that it remains true today, is that while we do utilize leverage, we try and take a very conservative approach towards leverage, both in managing the amount of overall leverage on a loan-to-value type basis, but also in managing our interest rate risk from a fixed rate versus variable rate scenario, for example. Over the last 2 to 3 years, we've heard estimates upwards of 50 to 60% of the types of properties, Class B, C, value add multifamily, upwards of 50 to 60% of those types of properties that were sold to buyers who utilized bridge loans for their acquisition. Bridge loans typically had 3 characteristics: high leverage, variable rate, and short term. So as So as in a rising interest rate environment, certainly there's going to remain some properties that are successful in executing their strategy, but properties that might have been a little bit underperformers, I think there's going to be some challenges from a refinancing risk. And as lending standards have tightened, there's going to be an overall tightening in the debt availability for multifamily, which we think is going to create some buying opportunities. So on one hand, we've remained conservative throughout our company's history. We've leaned heavily on agency type financing for the years, which has been a good stabilizer for multifamily in terms of while it may not always be the most aggressive debt product in terms of highest leverage, lowest interest rate, it's been a stabilizing force and one that we've utilized very successfully through the years.
Yeah. Well, Jack, you had mentioned how Burlington got into multifamily by taking back properties, not intentionally going into it. So you were lenders and you took back properties. So there's going to be lots of opportunities out there then, right? Depending on how bad the real estate markets get, it could actually be a big boon for investors in certain programs that are able to take advantage of it.
Correct. No, you're absolutely right, Brian. It's hard to say if we're going to head into a serious recession or not. As you know, the pundits have kind of flipped back and forth on that. So I'm not going to pretend to know, but we do hope that our patience and discipline and experience over time allows us to have the ability to invest in opportunities if they should arise somewhere. And I think an example today, you had said, what do you think is going to happen to some of the people coming in today? That's one, they overpay, they're over leveraged, and then they get in trouble. What we've done we're under contract now to acquire a property in Florida. And given that interest rates today and the lag of cap rates don't increase as quickly as interest rates do, particularly when the Fed is doing it on a regular basis. So in this upcoming property that we're acquiring, 80% of our equity going in with a JV partner has the priority payment of 6.5% currently and an 11% accrual. So what we're doing to make sure we still deliver good cash flow to our investors in this current environment, now it's changing, it's continuing to evolve, is that we have decided we're going to take a priority payment with a JV partner. We still have 20% of the money in all the upside, and then the cash flow after our 80% is paid. But we think that's a great way for us to continue to deliver good cash flow for our investors in today's environment.
Yes. Well, and so as you say, Jack, we're not sure how bad the recession is going to get, and many argue we were in a recession all last year. Even the good quarters had some bad elements for the domestic economy. It was mostly inventories and exports that took the numbers higher. So we might have already been in a recession all along. So even if the recession is tougher, investors who get involved in multifamily, it's usually a better category in some ways than office or retail or different types of real estate. And why would that be? What are the main characteristics that make multifamily really a great category?
I think Dominic touched on it, and rightly so. It has to do. We've had a huge run up in the price of homes over the last several years, where the median price has risen to over $450,000 from in the high 200,000s. So affordability is one of the main reasons renting is still going to be a huge part of residential real estate going forward. We don't see that changing, particularly if interest rates stay at the current levels. There has been a slight decline in the house, the values of the median houses going forward, but it's very slight, and it certainly isn't making up for the huge increase in housing prices going forward. So it's affordability, and most of the country that still can't afford to put a down payment on or pay the kind of mortgage rates today to buy a house. So that's one of the main reasons we think residential real estate rental is going to continue to be a very safe, relatively safe to other real estate investment opportunity.
Brian, a statistic I ran across recently that I just found amazing is 12 years ago basically in 2010, the average age of a first-time home buyer was 30, and last year it was 36. So on a percentage basis, kind of from a macro standpoint, that move is huge over a relatively short time frame to move from an average age of 30 to 36. Pretty remarkable and indicative of what's going on in certainly in the single family home environment today.
So that means that there's the buyers are older, they're buying later.
Yes.
So that plays into the strategy then.
Absolutely. Creating a larger pool of investors a larger pool of renters from all.
So what distinguishes a high quality project versus a lower quality project in multifamily? And we see all these apartment complexes all around America. What are the good ones doing that the bad ones are not doing?
I think a lot of it starts with site. Certainly starts with site location. A lot of it certainly starts with site selection. As Jack touched on earlier, we seek out locations where there's strong underlying single-family home ownership fundamentals. So, good access, good visibility, and favorable unit mixes. Some of the best examples have certainly been corrected over time, but in an example, where we create opportunity in taking what would be a little bit of a lesser quality property. When we talk about some of the fundamental elements, we have a property in Charleston performed very well for us, and it was built in the late 1970s, but its 2-bedroom units were 2-bedroom, 1.5 baths, which historically has proven to be a less favorable, or I'd call it a lesser quality, speaking to your question, type of floor plan, less desired floor plan. So that actually created an opportunity for us to, as part of our improvements to the property, to expand those to 2-bedroom, 2 full baths, which really enhanced the desirability. And so those are, some examples of whether we're talking about location, unit mix, certainly amenities. Again, I mentioned earlier, school districts, the proximity of good retail and jobs and access to the property are all types of distinguishing factors we look to.
And nice.
So just quickly, Brian, going back to Dominic's example of what we did in this property in Charleston, the other thing we did, the 1-bedroom units did not have washer dryer hookups. 2-bedroom and 3-bedroom units did. So what we've done on that, as part of our renovation and upgrades, we've added washer dryer hookups to the 1-bedrooms, and that's proven to be a great way for one to keep our property occupancy extremely high and to raise our rents a fair amount. So those type of things so that's differentiated. If you don't have washer dryer hookups today, you're in trouble relative to your competition. Amenities, these new properties now, they've got every amenity you can imagine.
Yeah.
It's just, they have fitness centers now that rival, the fitness centers that were built, in the 80s and 90s. I mean, they're just amazing.
gyms, swimming pool complexes in the center, all kinds of
Exactly.
perks and everything. We've seen everything now, and
Yep.
that people really like those amenities, don't they?
Yeah, they do. You know what the big one is now, though?
What?
Pickleball.
Pickleball. Yeah, pickleball.
Yeah. So we've transformed a couple of our tennis courts into pickleball courts, and the usage for pickleball compared to tennis is amazing.
Right. Pickleball and dog parks.
Dog parks. Yeah, got to have a dog park.
Exactly. Well, it's interesting. People want to enjoy where they're living and they want the amenities. And as it gets more competitive, the great operators find great things to do. And I know you guys are doing that. Well, good. So, we're kind of coming to the end of our discussion here. And I wanted to see if there are any big themes or messages that you'd like to leave our listeners with. I think the idea clearly that multifamily is a great category of real estate as part of an overall portfolio. But are there any other messages you want to share with everybody?
I think we still view real estate and multifamily, especially, as a long-term asset class. We can't predict exactly where we're at in the cycle, but we still believe that the long-term fundamentals for multifamily remain strong. And so we believe with our experience and approach and our vertical integration, we have the ability to perform through varying cycles and varying market conditions, but ultimately we still believe that the long-term fundamentals for multifamily remain strong from where we sit today.
Excellent. And any other thoughts, Jack?
No, I thought Dominic did a very good job. The other thing I would say also that's helped multifamily going forward is and this is the remote working element of many businesses today has been very beneficial for multifamily as well, because it allows for mobility if you are a renter as opposed to a homeowner. So we've seen the benefit of that in many of our properties where we've gained people from various parts of the country who come down now and say, well, I'm just going to be working remotely. Make sure you have good internet. Number one, that's another thing you got to have today.
The big deal. It is.
It is a big deal. But that's also plays into multifamily.
Yeah, absolutely. Well, great. Well, guys, this has been a great review. I know that many of our investors and many of the listeners of the show have invested in multifamily, and we would, of course, put the caveat out that every investment in alternative should be as part of a portfolio. We tend to over concentrate alternatives and diversify our stocks. We should be doing in many ways more diversification in alternatives, but there's great opportunity there. And I thought it was important that we invite you gentlemen on to talk a little bit about this, really one of the finest categories in real estate to invest in, and that's multifamily. So, gents, thanks for being with us today.
Appreciate it.
Really appreciate the opportunity.
Great. And thanks everybody for being with us today again on today's Market Explained 4-star video and podcast series. We're going to be back again very shortly with another either great interview or market commentary episode. So stay tuned, and we'll leave it there for today. Thanks everybody for being with us.